We ended the week with a fairly green day, the majority of companies, the majority of industries performing fairly well, recovering some of the drops we have seen over the last few weeks. But there's no way to hide, it was in fact an incredibly turbulent one, which does seem to be the continuous narrative. And if we just look at over the last 5 days, we do again see some strong green, lots of companies in fact up double digits, although there are some sectors that in a week like we saw were down. That is mainly the healthcare sector as well as the energy, which in fact when the market was down quite significantly, they were up, so it does look like rotation back into other sectors. Now, one of the industries that actually performed fairly well during the last week was the semiconductor space. We had Nvidia up 18%, Broadcom up more than 24%, AMD up 9%, and in fact it was the best week since November 2023. But also remember, we did just come out of a week which was very poor, where we saw $5 trillion wiped off the market, all down to the increases in the tensions in tariffs. And it's also been the worst start to a presidential term in history, so nice to see some green, some rebounds, and maybe some faith in the economy. Now, it's very important to understand, no matter what investment strategy you have, if you do sell out during some of the worst days in the market, you could be significantly reducing your long-term gains, especially if you are someone who is investing for the longer term, whether that's 5, 10, 15 or 20 years. And one graphic that we do believe is worth showing repeatedly is the one which shows timing the market versus time in the market. The main thing we want to highlight here, for example, the most recent large crash, 2020, the COVID era, the second best day happened immediately after the second worst. So if you were to move your money out when the drop did happen, you could potentially be looking at a lot of gains taken off the table. But one thing we know is that we know nothing. Given uncertainty is increasing, it is incredibly difficult to predict what is going to happen just over the next few hours, let alone the next few days, the next few weeks, as a lot of news has been coming out at a very quick rate. But one thing is for certain, under Donald Trump, uncertainty has in fact been at its highest, and that is above what we saw the global pandemic in 2020. And the fear and greed index is still sitting firmly in extreme fear. Whilst we are out of the low single digit that we saw over the last few weeks, around 3 to 4, we are sitting at 13, but investor sentiment is still very bearish. And rightly so, as we see China now retaliating to Donald Trump's in fact retaliatory tariffs. They've come back with a 125% on US goods, and they've gone as far as to call this a joke, something that they believe is now getting significantly out of hand. And in fact, if we just take a look at a little bit of the narrative, they've even come back to say that they will not respond to any further US tariff hikes, something that isn't a good sign, and ultimately we want to see both China and the US come to the table and come to an agreement. Now, just a bit of a backstory to how this figure did arrive. The initial tariffs that were in place were only 20%, as we can see. We then got Liberation Day, which was an increase of 34%, then a response to China's retaliatory tariffs at 50%, and then we got another response of 41%, taking it now to a very high 145%. And Kevin O'Leary has in fact come out and said this needs to be increased to 400%, where he says they need to level the playing field. At the moment, he says that they cheat, they steal, and they steal IP, and that he's unable to litigate in courts. Now, that is just his own opinion. Very unlikely we are going to see 400%, but always good to see what the analysts, what investors are thinking about the situation. And given this is the highest tariffs we have seen since the 1930s, many banks, many Wall Street analysts have continued to cut down their S&P targets, with a lot of them believing a recession is now on the cards if we aren't already in one. And we can see here, Jamie Dimon, the CEO of JP Morgan & Chase, believes that it is now the likely outcome. But something that's even more interesting is Goldman Sachs, who we do continually talk about, saying their odds of a recession continues to increase, they continue to hike it. After we did get that pause from Donald Trump, they in fact also pulled their recession call and don't believe it's likely for the US to enter into a recession. Again, things do change on a day-by-day basis, even on an hourly basis, as we have said earlier. But as an investor, this will always give you a great opportunity to take a look at your portfolio, consider whether or not some that sit in there are overvalued, maybe some are in fact undervalued, and see what opportunities are out there to consider to add high quality companies. And that is what we like to typically do on the channel. As we can see, some are fairly attractive. We have Qualcomm sitting at a forward valuation of 11 to 12, Alphabet 15 to 16, Adobe around 15. There are lots of opportunities, but again, there is a lot more to consider than just the valuation, but it could be a good starting point. And if you want to take a look, the current P ratio of the S&P 500 as a whole does hit around 26-27. For those that maybe have missed out on earlier episodes, the mean to median currently sits at 15 to 16, but that is going quite some way back in terms of the data points. If you just want to see, in fact, some of the most recent periods where the S&P price to equity ratio sits at, we can see at least from 1980 it has been on an increasing trend, but again, just data points you may want to consider. The other thing to note is that gold continues to hit an all-time high, continues to climb, and why this is something to take note of, because when gold prices rise, it usually means investors are getting nervous about the economy or the stock market, as it's seen as a typical safe haven. So when people start buying, it's often because they're worried about inflation, market crashes, and global uncertainty, as well as a warning sign that there may be trouble ahead. And another thing to bear in mind is that we have seen bonds starting to sell off. In fact, this is increasing yields above levels we haven't seen in quite some time. And when bonds yield go up, remember, it means it's getting more expensive to borrow money. It can slow down the economy because people and businesses might spend less. It also makes bonds more attractive to investors, so some money leaves the stock market, which can ultimately cause the prices to drop. And today we just want to cover Tom Lee and what he believes is going to happen in the market, his prediction. And if you remember from last month, we actually covered it where he was saying he believes the markets are incredibly oversold, incredibly pessimistic, a sizable rally is coming, odds of a 10 best day are right around the corner, and it isn't something we did get to see, at least in that period when he did come on to discuss his thoughts. And in fact, he did come on to CNBC where he is a typical regular guest. In fact, he apologized after Liberation Day. He said, "We want to apologize as the terms of Tariff Liberation Day were far worse than we expected. The resulting market fury is not due to a reaction to a trade war, but rather the fact that the White House broke a core covenant of capitalism, and that is why we didn't get to see what his eyes was a very high likelihood of a massive rally." Just yesterday, he came onto CNBC, where in fact he is discussing stocks, which ones he believes will increase over at least in the shorter term, and some which in his eyes aren't oversold, but he calls them sold out, and that is one step even further, where he does believe a massive increase, a massive rally is going to be coming, because those stocks are incredibly oversold, and a rally is pretty much the only conclusion. Now we're going to cover those stocks, but for those that just want to know, this is in relation to the Mag 7. He believes every single one of them is incredibly undervalued, and that they are a massive buy right now. We're going to cover those in the episode and give you our own thoughts. But also remember, just last month, he did believe a face-ripping stock market rally was around the corner, where he said a V-shaped rally for Tesla could ultimately carry the S&P 500 higher. And if we just take a look over the last 5 days, it is up around 15%, but year to date, the company, it is still down around 38%, trading towards the lower end of the 52-week low. Unlike Tom Lee, who does believe Tesla is one of the strongest buys in the market, every single analyst, Seeking Alpha, Wall Street and Quant, all believe the company is a hold, with a forward PE sitting at the 99 mark. And we do have a graph that he released a few weeks ago where he believes the bottom for the company is in fact in the low 200s, and that he sees this propelling up to $488 in 2025, there in turn making it in his eyes one of the best companies, one of the best in the Mag 7 to buy on the dip. And we just want to also highlight before running into our own valuation that it gets an F on the ratings. Main reason because it trades significantly above the sector of 13. You are paying a 641% premium, but a lot of investors believe that Tesla isn't a car company and should be thought about in terms of AI, robotics, and all of the other income streams like robotaxis Elon Musk said he will deliver in the short to medium term. We also want to point out it is marginally lower than what it's typically valued at 116, so right now trading at a 50% point lower. Now our valuation for Tesla does come to $203, where we have derived it from the DCF model. Now we'll show you we have the free cash flow year on year, including their most recent year. In fact, the average is negative. We do see it go from negative to positive for quite a number of years, and we've gone moving forwards 35%. As you can see, low, medium and high, 30, 35 and 40. Numbers here, as always, are subjective. you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is in fact for Tesla or any others. But we'll also want to tell you that we believe even these numbers here are incredibly high. This is something you would use if you believe Tesla can move forwards and very strongly as a market leader in AI, robotics, robotaxis, and all of the other avenues, including Optimus Robot. So 35% growth rate, 8% discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, 203, indicating downside of 20%, meaning right now, if you're buying this company, you need to believe at a bare minimum they can increase their future free cash flow at 40% year on year, and that would only give an intrinsic price of $274, indicating upside of only 8%. Now, as we typically like to do on the channel, we will use the median rate of 35%, and no surprise then, we have no margin of safety. Typically on the channel, we like to use 10%. We execute on that if it meets the 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. As you can see, if you did believe that, it would be a buy at $182. And for those that want to see at 15, 172, and at 20%, 162. So right now, we believe the company is trading at a premium unless you're someone in the camp that sees 40% at a bare minimum growth to the future free cash flow. Wall Street, on the other hand, they see this at $350. They see upside of 38% over the next year. And as always, give us your thoughts. Like Tom Lee, do you believe Tesla is a buy, or maybe you see it as a hold or a sell? Now, just before we move on to the next stock in the Mag 7, we want to let you know we have released our latest free weekly article. We covered 2 stocks we have been buying after this crash, and as always, we drop one to your inbox every single Monday morning completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a copy of 35 severely undervalued stocks for the month of April. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can grab a copy of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we move on to is Apple, which is in fact up 13% over the last year. Year to date though, down 21%, losing 1/5 of their market cap in 2025. Over the last 10 years, still massive outperformance of the S&P, trading towards the lower end of the 52-week range, just one buy rating from Wall Street alongside Tom Lee, and we can see their forward P of 26.5, not too far off the 5-year average of 27.7, and the yield on offer of 0.5, again, not far off the 5-year of 0.57. This in turn does give us a double reasonable valuation signal. And then when we move on to this valuation metric, remember the blue tunnel here is the expected fair price. We see this company trading in the midpoint or mid to lower, again another reasonable signal, but one thing we would say is Apple very rarely does come outside, so we do not very often get a severe undervaluation. Right now, triple reasonable signal for the company. Now, our intrinsic value of just under $200 derived from the DCF model is based on an 8% growth rate. Now, as we have said, we typically like to use the median rate, here is 10%, but with Apple, we don't see a lot of growth opportunities, at least in the short to medium term, so we have put it here at 8%, not far off their 10-year average. So based on the 8%, pretty much at what it's trading at today. So if you're someone that's been adding to the company near the market price, then right now baked in is around 8% growth to the future free cash flows over the longer term. For someone that believes it should be higher at 10%, 231, indicating 17%. And for those that believe it should be even higher at 12%, 266, 35%. As we said, we do believe 8% to be the most reasonable for the company today, and we get no margin of safety. We see this trading pretty much at its fair value. Perhaps you're someone that believes Apple deserves to trade at a premium, and therefore this is one that you want to consider. And we notice Wall Street see this at $250 over the next year, translating to 27% upside, but we'll show you at a 10% MOS, a buy at 180, at 20 around 160, which is probably where we would start to get a little bit excited, $160. At the moment though, fair price, upside of 27%. Give us your thoughts, buy, hold or sell. We then move on to Amazon, which is down 2% over the last year. Year to date, down 16%. Over the last 10 years, up 885%, trading towards the lower end of the 52-week range. A double strong buy from Wall Street and Quant, a buy signal from Seeking Alpha, and a valuation on a forward P around 29.3, which as we can see is significantly above the sector at 119%. Does it deserve a premium against the sector? You could probably argue yes it does. Given growth, it gets an A-, profitability A+, something we do dive into deeper when we look at stocks in a more in-depth review, and we can see it's trading significantly below their 5-year average of 176 by around 83%. That is what we would call again a severe undervaluation signal. Now our valuation gets to $230 today. Again, we have used the low growth rate at 20%, but you could actually argue that for Amazon 20% is maybe reasonable, but we have 25 and 30 for those that believe perhaps it should be larger. So 20%, it does come to $230, upside of 24. If you believe 25, 76% upside, and if you believe they can increase their future free cash flows at 30% for a sustainably long period, 145, more than a double from today's point. Now, in terms of the $230, you are getting a margin of safety today. At 10%, a buy at 207. At 20, pretty much where we see this now. So unlike Tesla and in fact Apple, where we saw no MOS, for Amazon, which we would call a high quality company, 20% MOS, 45% upside from Wall Street with their $268 price target. Do you see this as a buy, hold, or sell? We then move on to Microsoft, which is down nearly 10% over the last year. Year to date, down around 8%, but over the last 10, again, massive outperformance of the S&P, trading towards the lower end of the 52-week range. A strong buy from Wall Street and a buy from Seeking Alpha, and we do see it trading at a forward valuation of 28 below the 5-year of 32. So this is a severe undervaluation signal, although we do notice the yield pretty much in line with what it has offered over the last 5 years. And on this model, we do get that undervaluation as it is just below that blue tunnel. Similar to Apple, it is very rare for Microsoft to give us a severe undervaluation signal, so maybe this is one that we should in fact sit up and take note of. And our intrinsic value of $488 does in fact show upside of around 26%. We have used 16% growth rate. For those that do believe it is lower, we can show you the MOS shortly as well, but based on 16% moving forwards, you are getting at least a 10% MOS at 439, and as we do in fact keep going, similar to Amazon, in fact, you're getting a 20% margin of safety, although unlike Amazon, Wall Street see upside a little bit lower at 31%. They have a price target of $510. Now, if you're someone that believes it should be lower, and we do go for that 14% with an intrinsic price of 424, you are still getting a margin of safety pretty much around the 10% point at 382. But as always, give us your thoughts. Microsoft, maybe you've been buying, maybe you've been holding, or in fact you've been selling and doesn't fit your portfolio thesis. We then move on to Alphabet, which is down just around 1.5% over the last year. Year to date, down 17%. Over the last 10, up nearly 500%, trading towards the lower end of the 52-week range, a double buy from both Seeking Alpha as well as Wall Street, and a severe undervaluation signal, forward P at 17.6, well below the 5-year of 22.3, and a severe undervaluation signal, disparity between where the company sits and the blue tunnel. As well, great to see blue tunnel increasing. You want companies you're invested in, or even companies you're considering buying, to increase in value over time, but unlike the other companies we have seen today, there have been a few instances over the last 12 months where Google has been looking severely undervalued. Now, intrinsic price comes to $226. We have used a growth rate of 12%, which in turn gives 44% upside, and also alongside that a very large margin of safety, as we do in fact keep on going today. The most we have seen with 30%. Wall Street see this at 220, indicating upside of 40%. And for those that believe it should be lower at the 10% point, again, you are still getting a very healthy MOS, unlike the others we have previously seen, at 20%, with Wall Street again 40%. They see this at 220. Let us know, is this one you have been buying heavily given the large drop we have seen and the fairly attractive forward valuation? We then move on to Meta Platforms, which is up 4% over the last year. Year to date down 7%, but over the last 10, like every single Mag 7 today, massive outperformance of the S&P 500, trading towards the lower end of the 52-week range. A strong buy from Wall Street, a buy from Seeking Alpha, an undervaluation signal 21.5 below 23.4. However, we do in fact get a reasonable signal as it is sitting towards the lower end of the blue tunnel, although you could argue possible undervaluation as well. And our intrinsic value of around $700 is derived by using the lower growth rate at 10%. That indicates upside of 29, but again, you can see if you were to use the other two, again, we can show you for full transparency, at 12%, 805, 48% upside, and at 14%, 925, 70%. So being extra conservative at the 10% moving forwards, similar like we did see with Alphabet, it still gave us a 20% MOS, and Meta Platforms is in fact very similar. At 20%, a buy at 560. At 25, not quite there yet, somewhere between 20 to 25. Wall Street themselves incredibly bullish. Their price target $764. They see upside of 41%. We then move on to Nvidia, which is actually unlike the majority today, up 22% over the last year, down 17 year to date. Over the last 10, incredible outperformance, up nearly 20,000%. Trading around the mid to low end of the 52-week range, strong buy from Wall Street, a buy from Seeking Alpha, and a massive severe undervaluation signal. Forward valuation of 25, significantly below the 5-year rolling of 43, and one of, if not the lowest it has been over the last 5 years. And we also notice when we take a look at this model, massive disparity between where the 2 points sit, and in fact it has been only increasing from December in terms of severe undervaluation. Now our intrinsic value gets to $162, which when we take a look, we're using a growth rate of 20%. Bear in mind, over the last 5 and the last 10 years, free cash flow has been growing at a triple-digit rate, and based on the 20%, you are looking at upside of 48, but we just want to clarify, if you were to look at 15%, it isn't too far off the current price, so you could argue if you're buying now, already baked into the numbers is 15% growth over the longer term to the future free cash flows, but using the median rate of 20%, you are still getting a very chunky margin of safety. In fact, as we keep going for the AI giant, you're getting more than 30%, around $114. Wall Street incredibly bullish as always on this company, $177 price target. That in turn translates to 61% upside. Let us know, like Tom Lee, are you bullish on the Mag 7? Have you been buying? Or maybe you have a different perspective. Don't forget as always to sign up to the free weekly newsletter. We are dropping a fresh copy Monday morning. And as always, grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.